In this example problem, we are tasked with figuring out the operating income for Alpha Company. And the only part of this that's really hard that we're going to have is down here at the bottom, where we have to make their pro forma income statement. We got to project what our cost of goods sold is going to be based upon information that's provided in previous budgets. So scrolling back up to the top, what information do we have to work with right now to figure out what their revenues are going to be, what their COGS, all of that fun stuff? Well, we have Alpha Company's sales budget, and they're going to make four different products, which I've geniusly named products A, B, C, and D. And for each individual product, we have the expected sales volume they think they're going to have of that product. So 60,000, 40,000, 15,000, and 20,000 for products A, B, C, and D, respectively. And in total, they're going to move 135,000 units. The selling price of each individual item, and if you just multiply your expected sales volume by how much you think you're going to sell each one for, you get their revenue. So all in all, from the sale of these 135,000 various different products across the four product lines they have, they're expecting to generate $3,350,000 in revenues. They have to figure out how much that's going to cost them. And to do that, the first thing they need is to figure out what is their expected production volume. Zooming in again. There we go. They are going to sell this many units of each individual product. It's the same information that we had up above. 60,000 for product A, 40,000 for product B, 15,000 for product C, and 20,000 for product D. But just because they're going to sell that many doesn't mean they have to make that many. The reason being is they want some units in ending inventory as a buffer in case, sales is greater than they thought it was going to be and to be ready for the next accounting period. And they also have some finished units ready to go to be sold that are already produced and they don't have to produce them this period. So how do you figure out the units to be produced? It's the same formula over and over again. For each product, you take the expected quantity that is going to be sold and add to it the desired amount that you want to have in ending finished goods inventory. And that gives you the total units that are required. So for product A, if Alpha Company expects to sell 60,000 of these and they want to have 6,000 of them in ending inventory, that's 66,000 units they need in total. But they don't have to produce 66,000 because they already have 9,000 of these in beginning inventory. So they only have to produce 57,000 units of product A. And that same math occurs over here for products B, C, and D. We're always taking budgeted sales plus ending FG inventory gives you your total amount that's required, minus your beginning FG inventory gives you the amount you actually have to produce during the period. And product B, we're gonna have to make 38,000 of. Product C, we're gonna have to make 14,250 of. And product D, we're gonna have to make 19,000 of. So that's our production volume over here. We got to pay to produce those. How much do we have to pay? Well, for the materials, this problem is giving us how much cost goes into each unit. So each of those 57,000 product A's that we make is going to cost us 450 in materials. For product B, it's 550 a unit. For product C, it's $7 a unit. And for product D, it's 750 per unit. It's only one cost component. We also have to account for labor. And for our different products over here, we have how long each one takes to make. So products A and B both take 12 minutes to produce. Product C takes 15 minutes, and product D takes 18 minutes. And we're told that per hour, not per minute, our employees make $20 per hour in the process of making these products for Alpha Company. So we have our materials costs, we have our labor costs, we also have some operating costs going on over here. We have production development, which is basically R&D, fancy term, we're spending 190,000 on. We have $441,000 of marketing costs and $181,500 of distribution costs, of shipping costs. All of those are going to factor into our income as well, but they aren't going to factor into the actual cost of goods sold of our product because they are period costs. These are not costs that are directly related to the production process. They're just costs that we're going to pay and expense in their entirety at the time that they are incurred. Which brings us down to our pro forma income statement, our budgeted income statement, if you will, for the period. Start it like we start every income statement with our revenues. Well, where would you find your revenues from your sales? On the sales budget. And going back up to our sales budget, it's given in here that we are projecting we're going to have $3,350,000 of sales revenue. So I can bring that number on down. And now we got to compute our COGS, and that's where life gets interesting. We got to figure out what amount of cost we're going to put into each one of these jobs each one of these products for the units that we sell and eventually expense COGS. Well, let's start with our expected sales of each unit. And that's given also in the sales budget. We're going to sell 60,000 product A's, 40,000 product B's, 15,000 product C's, and 20,000 product D's. I go down here and just fill handle. I can fill in all of those numbers. Our unit costs, and I'm talking about these three guys over here, which I guess I'll highlight. There we go. We got to figure out how much each of these 60,000 product A's is going to cost us in terms of materials, labor, and overhead. Well, materials is easy, the way this thing's formatted, because it tells us right here that each product A is going to cost us $4.50 in materials. What about in labor costs? Well, product A takes 12 minutes to make, but we pay $20 per hour. So what I need to do is basically break this down into, okay, if it's $20 per hour, how much they earn every 12 minutes? And I can do that by taking the hourly rate of $20 and multiplying it by the portion of an hour that it takes to produce one unit of product A. And that portion is 12 minutes. And then there's 60 minutes in an hour. So I'm going to divide by 60. So basically what I'm saying here is they're earning 12/60ths of their hourly rate each time they take 12 minutes to produce a unit of product A. And when I put all of that in here, I come up with $4. So we got $4 of labor costs that are going to be incurred in the production of each and every unit of product A. And now we're on to our last part, which is how much overhead gets allocated. And down here, it's given in the problem that their predetermined overhead allocation rate from what I assume is one simple pool that keeps all of their indirect costs in it is $10 per labor hour. So I can use the same concept that I just had here to assign hourly wages because direct labor hours is their cost driver. I'm going to take that $10 per hour and I am going to multiply it by the portion of an hour that it takes to produce one unit of product A. And that is 12 divided by 60. So if it's $10 per hour and 12 minutes is 1/5 of an hour, that's $2 in overhead that we are incurring in the process of making each and every unit of product A. And then what is my unit total? It's just the sum of those three figures. And with that, our unit total for product A is $10.50 per unit. Well, now I need to find my total cost of goods sold from that particular model. Well, we know how many we're going to sell. We know how much each one is going to cost. And if you expense $10.50 every time you sell 60,000 units, multiply those two numbers together, the total COGS that we are expecting to record from the sale of product A during the period is $630,000. And for products B, C, and D, I'm just going to rinse and repeat that same process that I had before. For direct material costs for product B, the direct materials budget tells us that that product costs $550 in materials to make for each and every one of them. For our labor costs, well, it's the same amount of time as product A, so it should be the same, but let's be thorough and go through. And one more time, take our hourly wage rate. I'm going to multiply it by the portion of the hour that it takes to make one unit. So it would be 12 divided by 60. And that again comes up to $4, so I'm okay there. And then here for our overhead allocation, I'm going to take our predetermined overhead allocation rate of $10 and I'm going to multiply it by that 12/60ths to figure out what portion of that $10 goes into each unit. That's also going to be $2. I'm going to find my unit total by finding the sum of those three cost components, $5.50 in materials plus $4 in labor plus $2 in overhead. Means that we are assuming here that each unit of product B that we produce is going to cost $11.50. And if we sell 40,000 of those and we expense each one of those at $11.50 at the time of sale via COGS, it means all in all, across the sale of those 40,000 units of product B, we're going to record total COGS of $460,000. Two more products to go. Product C costs $7 per unit in materials according to our direct materials budget. As per our labor costs, the hourly rate is still $20 per hour, but this is a little more time consuming to produce. Each unit of product C takes 15 minutes. And If there's 60 minutes an hour, basically I'm saying they're earning 15/60ths, or reduce it down to one quarter, if you will, of that $20 every time they make a unit of product C, and a quarter of $20 is $5. And then I will do the same exact steps over here for overhead allocation, $10 being allocated for every labor hour that workers work on a job, multiplied by the portion of an hour it takes to make product C, which is still 15/60. Comes out to be $2.50. And then now my unit total for these three, I sum them up, and I come up with $14.50. Now, to figure out my total COGS from that product, I can take the $15,000 of expected sales, multiply it by the 1450 cost per unit, and it goes up to $217,500. And last of the Mohicans, product D, costs according to our direct labor materials, budget, $750. Our workers are still going to make $20 per hour working on this. But each unit of product D takes 18 minutes to manufacture. So they're going to earn 18/16ths of their $20 per hour RIP salary rate. And if I multiply that out, it comes out to $6 per unit. And then for overhead, same thing, $10 of predetermined overhead allocation rate times the 18/60ths of an hour that it takes to produce a unit of product D means that we're going to allocate $3 to each one of those products as we produce it. And if I go through and find the sum of those three numbers, each one of these costing $7.50 in materials, $6 in labor, and $3 in overhead, means that the unit total cost for product D is going to be $16.50. And if I take that $16.50 for each unit and multiply it by the number of units that we expect to expense when we sell them, I get $330,000 in cost of goods sold that we will record from the sale of product D. So what is my total COGS? Well, it's just the sum of the $630,000 that's going to come from product A, $460,000 that comes from product B, $217,500 that comes from product C, and $330,000 that comes from product D. And that totals up to $1,637,500. So what is my COGS on my pro forma income statement? Is that amount, $1,637,500. The next step in my pro forma income statement is asking me to figure out is my gross profit, and gross profit is always found as sales revenue minus your cost of goods sold. If we are selling these goods for $3,350,000 and they're only costing us $1,637,500, well, then we're marking them up $1,712,500 when we sell them. And that profit from just the markup that we have is hopefully enough to cover our non-product costs, our non-manufacturing costs, our operating costs, if you will, and leave us with some profit. So these numbers are just provided in the operating budget, or the non-manufacturing budget, as it's called sometimes. It's 190,000 for production development. For marketing costs, it is 441,000, and for distribution costs, it's 181,500. So what is my operating income? Well, operating income is just your gross profit minus this total amount of non-manufacturing or operating costs that you have to account for. So 1,712,500 minus 190,000 minus 441,000 minus 181,500 means that Alpha Company is going to generate on the dot $900,000 of operating income. I don't know why I have pennies. They can disappear. You shouldn't have pennies on an income statement. It's going to make people nuts. They're generating $900,000 of operating income from their production during the period. I will state that typically I would have a line here that says total non-manufacturing costs or total operating costs underneath to sum these three up, but I went with the templating that your textbook and your Connect software has. So that's how it looks. That's how you're going to figure out that number.